The Nasdaq is currently open and trading live, and Datavault AI stock is changing hands at exactly 47 cents per share, representing an intraday dip of 0.53% on heavy volume. That number seems small, almost insignificant, but looking closely at the trading volume of over 54 million shares changing hands in a single session reveals a massive underlying movement. The broader trading desk crowd looks at this price action and sees a struggling microcap penny stock that was once known as Wisa Technologies, completely missing the larger architectural shift occurring beneath the surface. The hidden insight here is that while the public market is pricing this asset like a dying audio hardware company, institutional block buyers are accumulating shares because of a massive corporate pivot toward high-performance computing data licensing. While retail traders are using basic retail investing platforms to day trade the daily fluctuations, larger operators are recognizing that the company is completely replacing its old hardware footprint with a high-margin data valuation business model. The market expectation is simple and cynical. Retail investors looking at basic online investing sites view this as another broken microcap that changed its name to ride a trendy technology buzzword. The reality, however, is a deeply complex financial restructure where a company is successfully using its legacy wireless technology to build a secure framework for real-world asset tokenization. To properly understand why the crowd is mispricing this asset, we have to dissect the immense tension between public perception and institutional execution. The retail sentiment on community channels and common trading platforms is that the stock is a speculative gamble, a tiny firm with a market capitalization hovering around $408 million that cannot possibly compete with established corporate giants. Investors frequently look toward industry-standard setups like Schwab Intelligent Portfolios or generic online investment advisors to construct safe portfolios, naturally filtering out stocks trading under $1. This structural filtering creates a massive structural inefficiency where early-stage microcaps undergo sweeping operational updates completely out of sight of the average participant. The common ground among market spectators is that microcap technology firms are burning through cash without any tangible asset base to sustain their valuations. But when we look at the actual mechanics of the business, that thesis begins to crack. The institutional framework surrounding the asset has quietly shifted, with specialized funds using advanced interactive brokers trading desks to quietly build positions without causing massive price spikes. When you look closely at order flows across a major interactive brokers platform, you can spot consistent block trades that point toward institutional accumulation rather than erratic retail speculation. This brings up an important point for everyone tracking this specific asset class. Comment below how many shares of Datavault AI stock you currently hold in your portfolio. Seeing how many people are positioned in these deeply volatile restructuring plays provides an excellent gauge of current sentiment. The massive disconnect in this specific asset becomes even more apparent when we analyze recent financial performance against public forecasts. During the first quarter update, the firm posted a spectacular 443% year-over-year revenue increase, bringing in $3.4 million. To the untrained eye using standard investing sites, that growth rate looks phenomenal, but the institutional expectations were actually much higher, resulting in a severe headline miss that caused short-term traders to dump their positions. This created a classic market anomaly where the stock price retraced despite massive fundamental expansion. If you pull up the detailed metrics on the Fidelity trading platform or analyze the order depth via the Fidelity mobile app, you can see that the selling pressure was largely driven by automated algorithmic programs reacting to the top-line miss rather than a structural failure of the underlying business model. Sophisticated investors utilizing advanced Fidelity investments infrastructure are looking past the immediate headline numbers to focus on the long-term price-to-sales ratio, which currently sits at a deeply discounted multiple compared to the broader software sector. The gross margin profile temporarily compressed to 3% due to intense integration costs associated with their recent high-performance computing acquisitions, but this is a typical characteristic of a technology firm mid-transition. While the standard retail trader sees a messy income statement on a basic Robinhood app interface, institutional analysts are modeling out the prospective cash flows from the newly established licensing agreements. This divergence in market analysis highlights the structural difference between self-investing individuals and multi-strategy institutional funds. The average person logging into their Robinhood stock trading account looks at a 5-day chart, notes the downward momentum, and immediately concludes that the asset is too risky to touch. They see the name change from Wisa Technologies to Datavault AI as a superficial marketing stunt designed to attract speculative retail capital. However, when you study the filings on a more robust institutional platform, the strategic rationale becomes clear. The organization didn't just change its name, it completed an extensive asset purchase from a private holding entity to absorb an entire suite of data valuation and security technologies. This integrated asset base allows them to offer secure corporate financial modeling and precise asset pricing structures to enterprise clients. While basic Robinhood Investments users are focused on tiny fractional share movements, major clearinghouses are tracking the corporate preparation for a potential spin-out of their legacy acoustic sciences business. If the company successfully separates its legacy wireless audio division from its high-margin software data platform, it could immediately isolate the
cash-burning hardware manufacturing expenses from the high-growth software licensing revenues. This exact catalyst is what short-term chart watchers fail to see when they simply glance at daily price ticks on an online investing application. The operational reality of the business model is centered around a highly technical architecture designed for secure data management and monetization. The company operates through two distinct but increasingly cooperative divisions, the Acoustic Science Division and the Data Science Division. The acoustic side retains the legacy portfolio, which provides foundational spatial and multi-channel wireless high-definition sound transmission technologies. This technology is already embedded across various consumer electronics through industry partnerships, generating stable but slower growth licensing fees. The true growth engine, and the reason the company is attracting significant interest across institutional interactive brokers account networks, is the Data Science Division. This segment utilizes high-performance computing to provide enterprise solutions for data asset valuation and secure tokenization. By creating digital twins that securely attach physical, real-world objects to unalterable metadata structures, they are addressing a massive corporate need for verified data integrity. Large enterprise organizations are sitting on massive troves of unstructured data that they cannot safely utilize due to regulatory scrutiny and severe privacy constraints. The proprietary software infrastructure developed here allows these corporations to safely evaluate and monetize their information assets without risking regulatory compliance violations. This structural capability is vastly different from what the market expects from a company that was simply manufacturing wireless audio modules a few years ago. The broader macro environment is also applying unique pressures to microcap equity valuations, making the distinction between active and passive management critical. In an environment where interest rates remain a persistent consideration, capital flowing into automated solutions like Schwab Intelligent Portfolios or broad-based Fidelity mutual funds completely bypasses companies trading under $1. These massive passive investment vehicles are legally or structurally prevented from purchasing microcap equities, which forces these smaller firms to rely entirely on self-investing participants or specialized active microcap funds. This structural lack of passive institutional support creates extreme volatility, as seen in the wide 52-week trading range of 47 cents to over $4. When a stock experiences that level of volatility, retail traders utilizing platforms like SoFi Invest or basic Robinhood crypto and cash management setups often get shaken out during sharp downside corrections. They fail to realize that the lack of institutional liquidity means that even minor shifts in buying or selling volume can cause massive distorted swings in the visible stock price. Experienced operators using specialized interactive broker stock trading tools look at these volatile liquidations as structural opportunities to accumulate underpriced equity before the broader market recognizes the fundamental stabilization. The firm's long-term corporate narrative is deeply tied to its historical evolution, which began all the way back in 2010 when it was originally formed as an audio technology venture. Over the next decade, the company went through multiple corporate transformations, listing publicly in 2018 and consistently trying to scale its wireless sound standards across the global consumer electronics market. While the engineering behind their wireless audio systems was widely praised and adopted by major brands, the capital-intensive nature of hardware manufacturing and global supply chain logistics severely limited their ability to generate consistent net profitability. Realizing the structural limitations of operating purely as a hardware provider, the executive leadership initiated a complete directional shift that culminated in the late 2024 asset acquisition of a private data sciences firm. This strategic move completely altered the company's financial trajectory, giving them immediate access to proprietary data valuation software and artificial intelligence agents. By rebranding entirely in early 2025, the company signaled to the financial community that its legacy as a pure-play semiconductor and audio firm was officially over. This historical context is essential for anyone utilizing online investing platforms to evaluate the asset today, because looking only at historical multi-year stock charts yields a completely inaccurate picture of the current software-focused enterprise. Looking out at the forward horizon, the strategic trajectory of the company will be defined by its ability to execute on its aggressive revenue projections while managing its immediate capital constraints. The management team has set an incredibly ambitious revenue target for the upcoming calendar cycles, aiming to scale their cloud-based software licensing platform across global logistics, healthcare, and digital entertainment sectors. A key part of this strategy involves forming highly specialized joint ventures, such as their recent partnership to create an integrated healthcare data and pharmacy logistics platform. By combining biometric data security with automated logistics software, they are attempting to construct a highly defensible niche market that requires both secure data validation and real-time processing capabilities. Furthermore, the company's unexpected move to secure high-profile international athletes as spokespersons underscores a calculated attempt to break into the sports and media data monetization market, where name, image, and likeness rights require absolute digital verification. If these cross-industry initiatives begin to show up as high-margin recurring software fees on upcoming corporate balance sheets, the current valuation will look exceptionally disconnected from reality. However, the path forward is filled with substantial structural hurdles that individual brokerage account holders must carefully weigh against the potential upside. Operating a global high-performance computing data platform requires continuous capital expenditure, and the company's current cash burn rate means that future equity dilution remains a constant risk for current shareholders. If the firm is forced to repeatedly issue new shares to fund its operational expansion, early investors could see their ownership stakes significantly diluted before the high-margin software revenues can fully mature. Additionally, the planned spin-out of the legacy audio business is a highly complex corporate action that could face face regulatory delays or unexpected structural friction, potentially tying up corporate resources when the executive team needs to be entirely focused on scaling the data division. For investors managing their own assets across standard SoFi trading platform setups or advanced Fidelity wealth management structures, the central question is whether the executive team can maintain its rapid operational execution before running into liquidity constraints. The tension between the market's expectation of a diluted microcap failure and the reality of a rapid software revenue scaling story is exactly what makes this asset one of the most polarizing setups in the current technology sector. In final analysis, the core thesis surrounding this unique corporate restructuring comes down to a fundamental mispricing of an operational pivot. The broader market, looking through the lens of basic online investing trackers and standard retail brokerage feeds, continues to penalize the asset for its historical struggles as a hardware manufacturer. They see the microcap valuation and the sub-dollar share price as definitive proof of structural weakness, leaving the asset completely overlooked by major passive investment vehicles and mainstream wealth management platforms. The reality, uncovered by analyzing institutional order flows and detailed corporate restructurings, reveals an organization that has systematically absorbed high-value data security assets to transform itself into a high-margin software licensing provider. With surging year-over-year top-line revenues, expanding cross-industry partnerships, and a strategic plan to isolate its legacy capital-intensive business lines, the company is quietly building an infrastructure that directly challenges the prevailing market.